Now let's look at the solution to inflation. Number one solution to inflation is increase in tax rates. When there's increase in tax rates, consumption expenditure of individuals will reduce because it will reduce their disposable income. Profit of firms will reduce. It will also reduce the investment of firms. So increase in tax rates will reduce the quantity of money in circulation. Number two is reduction in government expenditure. If government reduces expenditure on infrastructural facilities or on purchases, it will reduce the total money in circulation in a country. And when the supply of money falls, price level of goods and services will fall, which will solve inflation. Number three is increase in bank rates. Bank rate is the rate at which central bank lend to other banks, and that rate determines the lending rates of banks to customers. So if bank rate is increased, the interest rate on loans to customers will increase. Customers will be reluctant to borrow money. And when they are reluctant to borrow money, it means that the money circulation will reduce. Number next is surplus budget. If a country runs a surplus budget, it means that the income will be greater than expenditure, which means the country will control its expenditures, its spendings. And when expenditure is controlled, it means that the money circulation will reduce. And when money circulation is reduced, price level of goods and services will fall. And this will solve inflation. The use of subsidy is another ways of solving inflation. Government can subsidize essential products by making the price of essential product to reduce. And when that price reduces, it will reduce the total money in circulation in the country. Another example, another ways of solving inflation is government participation in production of goods and services. If government gets involved in producing goods and services, not only essential goods and services, it will make the prices of goods and services to be reduced. It will control price of goods and services. Suppliers and producers will not be able to increase price to exploit consumers. So price of goods and services will fall, which will be able to control inflation. Let's look at the effects of inflation in a country. What will be the effect of inflation in any country? Number one is that inflation leads to a decrease in money supply. Don't forget that number one, inflation leads to decrease in value of money. Don't forget that I've explained what value of money is. I said value of money is the purchasing power of the people, which is the quantity of goods and services that money can buy. So when the price level of goods and services increases, definitely there's inflation, which means that value of money will fall, which means quantity of goods and services that money can buy will reduce. Number two is that fixed income earners, they lose during inflation. Those that earn a fixed amount of money, price of goods and services has increased, the quantity of goods they can buy will reduce. So they lose during inflation. Creditors or lenders, they lose during inflation. A creditor that borrows someone 50,000 before inflation, during inflation, the person is receiving the same amount, which means that that amount cannot buy what it used to buy. So creditors lose during inflation. Businessmen gain during inflation. So businessmen, they gain because if there's increase in price of goods and services, they will add it to the final price of their goods and they'll make profits through that means. Borrowers gain during inflation. Borrowers or debtors, they do gain during inflation because the fixed amount they borrow is what they will return at the due date. All right. The final effect of inflation is that it reduces savings because price of goods and services has increased, so it will be difficult to save. And when it's difficult to save, it will be difficult to invest.